Hey everyone, and welcome to another deep dive, this time into building a diversified investment portfolio, even if you don't have a ton of money to start with.
A very timely subject, I'd say.
Definitely. And we've got a great article to break down today. It's by certified financial planner Robin Hartle.
Oh, yeah, I read her stuff.
It's called 7 Ways to Build a Diversified Portfolio Without a Ton of Money.
Catchy.
Right. And the listener for this deep dive is someone who's eager to grasp the essentials of smart investing. Especially you know how to spread that risk and potentially boost their returns.
Yeah, most investors could use more of that.
Exactly. So we'll uncover why typical diversification advice is so hard to follow, what a truly diverse portfolio actually looks like, and some simple shortcuts to get you started. Think of it like building a winning sports team, but for your money.
I like that. A team of all-stars, each with their own strengths.
Perfect analogy. So let's jump right in. Why is it such a challenge for everyday investors to build a truly diversified portfolio from scratch? What makes it so tricky?
Well, diversification, it sounds simple on the surface, right? Don't put all your eggs in one basket. But when the market takes a hit, and it always does, that basket could represent a whole lot more than just one stock.
The article gave an example about owning a bunch of different stocks, but maybe they're all in the tech sector. So if tech stocks plummet, your whole portfolio takes a nosedive.
Right. You might think you're diversified, but you're really not. It's about more than just owning a bunch of different things. It's about owning the right things that react differently to different market conditions.
Like having a well-rounded team that can handle any situation. So now I'm really curious, what does a truly diversified portfolio actually look like?
Yeah, that's the big question. It's not just about tossing some stocks and bonds together and hoping for the best. It's much more nuanced than that.
Okay, so spill the beans. What's the secret sauce?
Think of it as a spectrum. On one end, you have those all-or-nothing portfolios, incredibly risky, like betting everything on one horse race. On the other end, a portfolio so spread out it barely moves, like a giant cruise ship, super stable, but not going anywhere fast.
So true diversification lies somewhere in between, right? Finding that sweet spot where you're managing risk, but also positioned for growth.
Exactly. And this article lays out a great checklist of core components for a truly diverse portfolio. It starts with exposure to stocks of all sizes, from those small, high-growth companies to the big, stable corporations.
Okay, so that's the stocks part of the equation. But what about those assets that are considered safer?
Right, bonds. They're often seen as that counterbalance to the volatility of stocks. And even within bonds, there's a spectrum of risk, right? You have government bonds, generally considered more stable, and corporate bonds, which can offer higher potential returns, but also come with higher risk.
So we're building a team with a mix of offensive and defensive players. Got it. But the article also mentions looking beyond our home country. Why is that so important?
Because the global market offers a huge opportunity. Tapping into international stocks and bonds isn't just about chasing potentially higher returns. It can actually help reduce risk, too.
How so?
Well, think about it. If one country's economy is struggling, others might be thriving. By spreading your investments across different economies, you're less exposed to the ups and downs of any single market. It's like diversifying your supply chain so you're not reliant on just one source.
Wow, that makes so much sense. Spreading the risk across different economies, tapping into growth wherever it pops up. But building this dream team of investments from scratch, it sounds a bit overwhelming.
Yeah, it can be. And that's why those shortcuts we mentioned earlier are so valuable. Robin Hartle outlines 7 strategies that even beginners can use to build a diversified portfolio without getting lost in the weeds.
Okay, I'm ready to simplify things. Let's dive into those strategies.
hmm
First up, index funds, your one-stop shop. Sounds promising.
This is where things get interesting and thankfully a lot simpler. ETFs and mutual funds, particularly index funds, they're like pre-built diversified teams.
So instead of trying to pick winning stocks myself, which feels like a gamble sometimes, I'm buying a slice of the entire market with one purchase.
Precisely. Instant diversification. For example, an S&P 500 index fund, that invests in 500 of the largest U.S. companies, so you're instantly exposed to a huge chunk of the market. And there are total market funds, too, for even broader coverage.
Wow, that simplifies things a lot. No need to scout and recruit every player for my team individually.
Yeah.
So index funds take care of the stocks side, but what about those defensive bonds?
Bond index funds, same idea. You can find bond index funds that track various segments of the bond market, so you get instant diversification across a range of bonds, smoothing out those inevitable stock market swings. It's all about balance,
Right,
really.
perfect sense. It's like building a team with both star strikers and a rock-solid defense. But how do I know how much of each I should have? What's that ideal balance between those offensive stocks and defensive bonds?
Asset allocation. It's figuring out that perfect mix based on several things: your age, risk tolerance, and financial goals. A younger investor with more time might lean towards stocks, while someone nearing retirement might prefer a more conservative approach with more bonds.
Right, like a younger team might take more risks for big wins, while a veteran team focuses on consistency. But what if my goals are different, like saving for a house or something? Does that change things?
Absolutely. Your investment goals are super important. Someone saving for a down payment in a few years will take a different approach than someone investing for retirement decades away.
So it's not one size fits all, it's personalized. What about my risk tolerance? I know some people get a thrill out of those big market swings while others prefer a smoother ride.
You got it. Risk tolerance is key. Some folks love the roller coaster, others not so much. And things like job security or family obligations, they can all factor in.
So many things to consider. But it sounds like there are resources out there to help figure this all out.
Oh yeah, for sure. Lots of online brokerage platforms have tools and calculators to guide you. Some even provide personalized recommendations.
This is making a lot more sense now.
hmm
But part of me still loves the idea of picking individual stocks. Is there a way to do that responsibly within a diversified portfolio?
Definitely. It's finding that balance between the excitement of stock picking and that solid diversified foundation. That's where the 5% rule comes in.
Yes. That rule was highlighted in the article. It's like a safety net to make sure I don't go overboard with those individual picks.
Exactly. No matter how confident you feel about a particular stock, the 5% rule says no more than 5% of your total portfolio value should be in any one company. So let's say your portfolio is worth $50,000, you shouldn't invest more than $2,500 in any single stock.
Got it. Even if I think I found the next big thing, don't bet the farm on it. Limit that exposure.
And there's more to the 5% rule. It also suggests not putting more than 20% of your portfolio into any single industry. Even if you're super bullish on, say, renewable energy, don't put all your eggs in that basket.
Makes sense. Diversify even within your favorite sectors. But doesn't this rule get a bit murky if I'm investing in a diversified fund that already holds many stocks?
Good question. And the answer is not really. The 5% rule is mostly focused on those individual stock picks you make yourself. If you're holding a diversified fund, that risk is already spread out across multiple companies.
That's reassuring. Okay, so I can explore individual stocks, but keep that 5% rule in mind.
Yeah.
Now, what about those investors who are really interested in specific industries, like someone who's super passionate about, say, artificial intelligence or clean energy? Is there a way to focus on those areas while still staying diversified?
There absolutely is. That's where sector funds come in. They give you targeted exposure to a particular industry, but still offer diversification within that sector.
So instead of picking one or two EV companies, I could invest in a sector fund that holds a basket of companies related to the whole electric vehicle market.
Exactly. You're not betting on one company, but on the growth of that whole sector.
That's a cool strategy. It's like having a specialized team within my larger diversified portfolio. Okay, last question before we move on. I used to think that owning a ton of different funds was the key to diversification. Is that right?
That's a common misconception, and it's one this article debunks really well. More funds don't automatically equal better diversification.
Okay, so it's not quantity, it's quality.
It's all about what's inside those funds.
Hmm.
The holdings, their weighting, their characteristics. You could own 10 funds, but if they all invest in pretty much the same stuff, you're not truly diversified.
It's like having a basketball team of all point guards. You need players with different skills to win, right?
Exactly. You need funds that invest in different asset classes, different sectors, different geographic regions to be truly diversified. It's about building that well-rounded team.
This is eye-opening. So I can't just buy a bunch of funds and call it a day. I need to look under the hood and make sure they're working together like a well-oiled machine.
You got it. Be intentional with your choices. And that brings us to a strategy that can be a game changer for those who feel overwhelmed by all this: automation.
Okay, tell me more about automation. How can it help with diversification, especially for busy people like myself?
We're talking about tools like target date funds and robo-advisors. They take a lot of the guesswork and emotion out of investing. Think of it like having a skilled coach to manage your team's strategy.
That sounds appealing. Instead of constantly trying to time the market or tweak my portfolio, I can rely on these tools to make those decisions for me.
Precisely. Target date funds are your set it and forget it option. You choose a fund based on when you expect to retire, and it automatically adjusts its asset allocation as you get closer to that date, becoming more conservative over time. Pretty cool, huh?
So It's like having a coach who knows when to pull back on the risk as the game clock winds down. I like that. Now, what about robo-advisors? I've heard that term, but I'm not sure I fully get it.
Robo-advisors, think of them as digital investment platforms. They use algorithms to manage your investments for you.
Algorithms. Sounds a bit complex.
It might sound that way, but they're surprisingly user-friendly. When you sign up with a robo-advisor, you'll answer some questions. Your financial goals, risk tolerance, time horizon, that kind of stuff.
So it's gathering data to personalize the experience, just like those personalized ads you see online.
Uh-huh, yeah, sort of. But this time it's working in your favor. Then, the robo-advisor creates a personalized portfolio just for you using ETFs and mutual funds.
So it's creating my dream team based on my specific needs.
That's impressive.
And it actually manages it for me.
It does. It continuously monitors your portfolio, rebalances it as needed, even adjusts over time as your circumstances change. It's like having a personal financial advisor working for you 24/7, but at a fraction of the cost.
Now that is impressive. Robo-advisors, I'm definitely intrigued. Before we go to the final strategy, let's recap. We've established that diversification is more than just stocks and bonds. It's about weaving together different asset classes. We've also talked about index funds, the 5% rule, and now automation, all strategies that make diversification accessible.
You got it. It's taking those first steps and building that solid foundation for long-term success.
Love it. And for the grand finale, the last strategy focuses on that sports analogy. It's called building a winning team, not just an MVP. Tell me more about that.
This one emphasizes the idea that a diversified portfolio is like a team with players who have different strengths and weaknesses.
Instead of trying to find that one superstar stock that will make me rich overnight, I'm assembling a team of solid performers who can cover all the bases.
Exactly. It's like in any sport, a well-rounded team is essential for consistent success. You need players who excel in different situations, some who are great at offense, others at defense, and some who can handle the pressure when it matters most.
So it's about taking the pressure off, trying to find that magic bullet investment,
Yeah.
and instead focusing on building a resilient team that can handle any market conditions, right?
Yes. A more sustainable, less stressful approach, honestly. It's playing the long game and letting the power of diversification work its magic over time.
I love that. It's about building a winning team for your financial future. That's the beauty of this strategy, isn't it? Shifting from short-term gains to building a resilient portfolio that can help you reach your long-term goals.
Absolutely. It's a much more powerful and empowering approach to investing.
This has been an awesome overview of these 7 strategies. We've covered a lot, but hopefully you're feeling ready to take some action and build a diversified portfolio to reach your goals.
That's what we're here for. Remember, you don't need a ton of money to get started. Just a little knowledge, the right strategy, and the willingness to take that first step. And that's what we're going to help you with in the next part.
Welcome back, everyone. I'm excited to dig deeper into these diversification strategies and, actually putting them into action.
Yeah, let's get practical.
Exactly. We talked about index funds being that great starting point, that one-stop shop for diversification. But where do I actually go to buy these index funds?
First things first, you'll need to set up a brokerage account. Lots of online platforms these days, they make buying and selling investments super easy.
So I open an account and it's like online shopping for investments.
Pretty much. You can search for funds by their ticker symbol or by their investment objective, like large cap US stocks or emerging market bonds, that kind of thing.
Okay, so I add them to my cart, check out, done. Sounds almost too good to be true.
Not so fast. One crucial detail, the expense ratio.
Expense ratio, what's that?
It's basically the annual fee you pay to the fund manager. Think of it like a management fee. It's expressed as a percentage of your investment. So, if a fund has an expense ratio of 0.05%, you'd pay $5 a year for every $10,000 invested.
Okay, so the lower the expense ratio, the better.
Exactly. More money stays in your pocket. So you found some low-cost index funds that you like. What's next?
Asset allocation, right. Figuring out how much to put in each fund based on my age, risk tolerance, all that good stuff.
You got it. And luckily, a lot of these online brokerage platforms, they have tools and calculators to help you figure out your ideal mix. Some even give you personalized recommendations.
So they do the heavy lifting for me. Awesome. Okay, I've picked my index funds, figured out my asset allocation using those handy tools. How do I actually buy the index funds?
Just like buying a stock. You enter the ticker symbol, how many shares you want, and place your order. Lots of platforms even have recurring investments, so you can automatically contribute on a regular schedule. Really simplifies things.
Wow, put my diversification on autopilot. I like it. But before I get carried away with automating everything, what about those of us who still like to pick individual stocks?
We haven't forgotten about you. Stock picking can be exciting, but remember, do it responsibly within that diversified framework. That's where the 5% rule comes in handy.
Right, that rule helps prevent us from getting too concentrated in any single company, even if we're feeling super confident about it.
Exactly. Manage that risk, protect your money. So, before you jump on that hot stock tip you heard, take a minute to calculate how much you can invest while still following the 5% rule.
So it's like setting a budget for that individual stock. A, don't spend more than this limit, no matter how good it looks. Okay, walk me through it. How do I actually apply that 5% rule?
First, figure out the total value of your entire investment portfolio, everything you own, not just stocks. So let's say it's, I don't know, $100,000. 5% of that is $5,000. That's your max for that particular stock, even if you're tempted to put in more.
Okay, so even if I think I found the next Apple or Tesla, stick to that limit.
And remember that industry part of the rule too. No more than 20% in any one industry. So if you're super bullish on renewable energy, don't put all your money into solar panel companies, right? Spread it around within the sector too.
Diversify even within my favorite sector. Got it. But with all this to keep track of, individual stocks can feel a bit, I don't know, time-consuming, maybe even a bit stressful.
Absolutely. And that's where those automation tools, like we were talking about earlier, can be super helpful. Target date funds and robo-advisors, they can really take a lot of the work off your plate.
Okay, yeah, let's circle back to those. How can those help simplify diversification?
Think of it like this. You have a dedicated coach. They create your personalized game plan. They make adjustments as needed, keep your team in shape. They even make those tough calls during the game. And they don't charge you an arm and a leg. That's what these tools can do.
Okay, I'm listening. Tell me more about target date funds. How do they work exactly?
They're like that set it and forget it option. You pick a fund based on your planned retirement date, and it automatically adjusts its asset allocation over time, becoming more conservative as you get closer to that date. Pretty cool.
Right. So if I'm aiming to retire in, let's say, 2050, I'd pick a target date 2050 fund, and it would shift from a more aggressive stock-heavy approach to a more conservative bond-heavy approach as I get closer to retirement.
You got it. It's like having a coach who eases up on the training intensity as you get older, focusing more on recovery and injury prevention as you approach the big game.
I love that analogy. Makes it so much easier to understand. Okay, now break down robo-advisors for me. How are they different?
Robo-advisors are like your personalized digital investment coach. They take a deeper look at your specific goals, your risk tolerance, your time horizon, all that, to build you a truly customized portfolio.
So it's taking all those factors into account, not just my age.
Yeah.
Awesome. And it manages the portfolio for me, right?
Yep. They monitor your investments, rebalance as needed, even adjust over time as your situation changes, like having a personal financial advisor working around the clock, but way more affordable.
Wow, that's pretty incredible. Do they make specific recommendations for things like index funds and individual stocks?
Absolutely. Usually they build a diversified portfolio using ETFs and mutual funds based on what you need and what you're comfortable with. Some even give you individual stock recommendations, but always with the emphasis on staying diversified.
This is amazing. Sounds like robo-advisors can really take the headache out of diversification, especially if I don't have the time or the knowledge to do it all myself.
And the lower fees are a huge bonus. Makes these tools accessible to a lot more people. Okay, before we move on, just want to make sure we're hitting those key points. Index funds, the 5% rule, and now automation. Any other essential tips to keep in mind for those starting their diversification journey? Remember, diversification isn't a one-and-done thing. It's ongoing. It needs regular checkups and adjustments. Just like a coach constantly evaluates the team and tweaks the game plan, you'll need to review your portfolio periodically to make sure it's still on track.
Right. Life happens, goals change, markets go up and down. It's not set it and forget it.
Yeah.
Got to stay involved and make sure my portfolio is still working for me.
Exactly. It's good to review at least once a year or, whenever a big life change happens, new job, getting married, starting a family, things like that.
Just like a coach might adjust the lineup based on a player's injury or change in strategy, we need to be flexible too. But it sounds like there's a lot of support out there if I need help.
Oh, tons. Websites, books, forums, even financial advisors if that's what you prefer. And don't underestimate the power of community,
Yeah, look, talking to friends and family about investing.
Yeah, sharing knowledge, getting insights, even staying motivated. It helps.
Building a supportive team, not just for my investments, but for my overall financial well-being.
I love that. And sometimes, the best lessons come from hearing about other people's experiences, maybe even their mistakes.
For sure. Don't be afraid to ask questions, get advice, learn from others who've been there, done that.
This has been so helpful, really breaking down those practical steps. We've talked about everything from picking index funds to setting up a robo-advisor. But before we wrap up, I want to leave our listener with a thought-provoking question.
Okay, I'm intrigued. Let's hear it.
Now that you have a better idea of what diversification is and how to do it, think about this. What kind of investment team do you want to build to reach your financial goals?
Love that question. It's time to envision that winning lineup, the one that's going to help you achieve those financial dreams. And remember, it's not just about the players. It's about the coach, the strategy, the mindset. It's about playing the long game.
Absolutely. Playing smart, staying disciplined, never giving up on those financial aspirations. That's what it's all about.
Now, before we go to our final part, we're going to take a quick pause. When we come back, we'll wrap up our deep dive with some final thoughts and actionable advice to help you get started today. Stay tuned. We're back and ready to wrap up our diversification deep dive. I hope you're feeling inspired and ready to take action.
Me too. Before we finish, I want to emphasize one key takeaway.
Okay, lay on me.
It's that mindset shift that comes with embracing diversification. It's about letting go of that get-rich-quick thinking and really embracing that power of slow and steady growth.
That's so important. It's easy to get caught up in the hype, the
Yeah.
latest hot stock, the next big thing.
Yeah.
But building real wealth, it's more like a marathon than a sprint.
Couldn't agree more. Diversification is about playing the long game, building a portfolio that can handle those market ups and downs and deliver those consistent returns over time.
It's like building a strong tree that can weather any storm, not a flimsy house of cards.
Perfect analogy. And just like a tree needs deep roots, a diversified portfolio needs that solid foundation of different asset classes, different sectors, different regions. We've talked about all that good stuff.
We have index funds, robo-advisors, even the 5% rule to keep us in check.
Right. It's like having that voice of reason whispering, don't put all your eggs in one basket, no matter how tempting it might be.
Such a crucial reminder. And it's not just about mitigating risk, it's also about capturing those opportunities, right?
Yes. Investing in a wide range of assets, it means we're positioned to benefit from growth wherever it happens, whether it's emerging markets, new technologies, even those unexpected sectors that do well when the economy takes a hit.
It's like having a global network of scouts, always on the lookout for the next big thing, always making sure our portfolio is ready to perform.
Exactly. And with the tools and strategies we've discussed today, building that globally diversified portfolio, it's easier than ever.
Couldn't agree more. And whether you're a beginner or you've been investing for a while, there's always more to learn, always ways to fine-tune that portfolio. But the most important thing is to actually get started.
Absolutely. Don't let fear or procrastination hold you back. Start small, learn as you go, and remember, even those small steps, they can add up to huge progress over time.
You've heard it here, folks. You're armed with the knowledge and the strategies to build that robust, resilient portfolio. It's time to put those insights into action, build that dream team of investments that will help you reach those goals.
It's been a pleasure diving deep with you.
Likewise. And to our fantastic listener, thank you so much for joining us on this journey of discovery. Until next time, stay curious, stay informed, and keep diving deep.